I got a couple, well, maybe a little bit more than a couple, but a few questions I'd like to go through. So we're going to talk to Ron about retirement income planning. So Ron, I'll give you a little bit of a background. He's a fiduciary investment advisor, very qualified, manages tens of millions of dollars of clients' assets. He's very skilled and an expert in the retirement planning space. And he has a really good idea on how we can actually not only build and accumulate wealth, but also how you can preserve that wealth and safely turn it into income that you can actually spend. So this is the hottest topic right now in the retirement planning space, I think, is not necessarily how much of a rate of return are you going to get on your money, but how do you make sure your income and your paycheck never stops? How do you always have a paycheck? How do you always have spending money no matter what's going on in the markets? So I guess maybe that'd be a good place to start. What are some of your opinions on that, being in the retirement planning space, being an investment advisor, piggyback off of that?
So the biggest challenge that I see is when people are trying to retire is they know how much money they have. They just have no idea what that money is going to do for them in retirement as far as creating retirement income. Because when people get to where they're in what I call like the preservation phase, like within 5 years out from retirement, really the rules of the game change completely. Because for the past 30 or 40 years, they've been a saver. They've been an investor. It's been about discipline. It's about sacrifice, denying yourself, investing money into your 401ks, your Roth IRAs, your brokerage account. Maybe they're using cash value life insurance like you do. And they've been accumulating money, right? But now the rules of the game are going to change completely, because now it's about how can we take money out of our investment accounts? How can we replace our paychecks? And how can we do that safely and reliably and consistently throughout all the market ups and downs, right? And again, some of the biggest problems we see, and I know that you're aware of this as well, Mike, is that people think, well, because over long term, the market averages 8%, I should be able to take out 8% of my portfolio every year.
Right. Because isn't that what Dave Ramsey says? He says you should, if you have a stable growth mutual fund, you can make it 12% and you should comfortably be able to spend 8% every year. That's pretty, he's been saying that for years, hasn't he?
The problem is, when I teach my retirement planning classes, we'll bait the crowd into this and I'll say, well, that makes sense, right? The market average is 8. You should be able to take out 8%, right? And without even dipping into your principal. Doesn't that make sense? And everybody sits there and nods like, this makes sense. And then I'll say, okay, next question. Does the market go up 8% every single year? No. Well, okay. Does the market ever go down? Yes. And then I've got some slides that I show in the class, and it's like, and people don't understand the compounding effects of losses, because when you lose 20% in the market, how much do you need to break even? And most people say 20, and that's incorrect. If you lose 20% in the market, you actually need to make 25% to break even. But if you're retired and if you're taking money out of your portfolio for income, if the market goes down 20% and you compound that loss or compound the downturn because you took out too much, you followed Dave Ramsey and took out 8%, well, you just took a 20% loss and turned it into a 28% loss. And now you got to make about 35 to 37% just to break even.
Wow.
And what happens when we have two back-to-back down years and the market goes down 30% and you've taken out 15 or 16? Because you're following this advice, right? Like in just a couple of years, you can cut your portfolio almost in half to recover, because you're going to need the market to go up 60, 70, 80% over the next few years, but you're continuing to withdraw 8% because that's what you were told that you could do. That's what you're relying on. And you're just sending your portfolio into a downward death spiral that you'll never be able to recover from.
Wouldn't it be fair to say that if you're getting your retirement planning advice and from one of those conventional talking heads, that it'd be pretty dangerous? Like not only is it like just not a good idea, but it could literally ruin your life. Like you just said, if you withdraw too much too quickly, your portfolio goes into a death spiral and you can completely run out of money. So really do got to be careful who you're talking to in this space.
Absolutely. And if you just retired and if you took out 8% the last couple of years, you're fine, because the last couple of years the markets went up. But you think about in 2022 and the market went down almost 25%, if you'd have taken out 8% that year, like you're really kicking yourself while you're down, so to speak. So the research has all been done because we have 100 years of rolling stock and bond market data all the way back to the 1920s. And see, we know what the safe withdrawal rate is. With a very high chance of success, the safe withdrawal rate is 4%. And if you want to take out more than that per year, you increase your chances of running out of money. And being in the retirement income space and having these credentials from the American College of Financial Services, being an expert here, I know the statistics. Like if you do a 5% portfolio withdrawal rate, your likelihood of failure goes up to 15%. Maybe you can live with that, right? That would be like an 85% chance of success. That would be like a B on your retirement report card. But if you go up to 6% withdrawal rate, that drops your success rate down to 70 or 75%. And now
Wow.
you're looking at like a C minus. And if you do what Dave Ramsey says, the portfolio failure rate is over 50%.
Wow.
So historically, more than half of all market cycles that you would have experienced, you would have run out of money at some point. So
Wow.
4% is a safe withdrawal rate if you just follow the conventional wisdom of leaving all your money invested in stocks and bonds. Maybe you do like 50% stocks, 50% bonds, or maybe 60, like a 60-40 portfolio. But the problem with that is it doesn't give you very much income. That's the problem.
Right. And I think that leads really well into the next question here. So like we were talking about earlier when we first started this, a lot of people are really focusing on the best rate of return or chasing that rate of return. Why do you focus a little bit more on the retirement income that you can get rather than the rate of return? Like what's the reasoning on that?
Well, because average rates of return only matter during the accumulation phase of your life. When you're 35, when you're 45, when you're 55, average rates of return matter. But once you retire and begin taking withdrawals out of your portfolio, average rates of return don't mean shit. Because when you retire, when you have a couple back-to-back down years and you're withdrawing money out of your portfolio, which is accelerating the downward spiral, averages don't mean anything if you retire and 5 years into retirement, your million is now down to 500,000 because you ran into a bear market and you're taking too much money too fast, right? That's why average rates of return really don't mean anything in retirement. So there's this huge paradigm shift in your mental thinking. If you want to retire successfully, with confidence and worry-free, making that transition into retirement. Absolutely.
Right on. I like that answer. So there's also another controversial topic in this retirement planning space. In addition to how much you can withdraw from stocks, it leads into this question of the safe withdrawal rate and how to increase your income distributions. And one of the things that you'll hear is, should I get an annuity? How is that going to help me? What's the problem that a lot of people have with annuities? Is it really as controversial as people say it is? Can you talk a little bit more about where an annuity can fit and maybe some common misunderstandings of annuities?
Absolutely. So I'm with Michael Finke, who's a lead professor of wealth management at the American College of Financial Services. He says that annuities are the most efficient and effective tool for creating retirement income, not for investment growth, but for creating retirement income. And the reason why is he basically says that you can have a riskier retirement that will cost you more, meaning if you take it out of stocks and bonds, or you can have a safer retirement that will cost you less, meaning if you put your income money into a guaranteed income annuity. Why is that? Again, with stocks and bonds, you can safely withdraw 4% per year. With an annuity, depending on your age and the survivor benefits that you want, your withdrawal rate is often 7, 8, or even 9%. And because it is an insurance contract and it's not an investment, there's no volatility and there's no market risk. So if I have someone set up in an annuity and their annuity is paying them $50,000 per year, what happens if they set a world record for longevity and they live to age 125? Nothing. The annuity keeps on paying, right? It's a guaranteed lifetime pension or guaranteed lifetime income. And what happens to that $50,000 per year if the market crashes 40%? Nothing. It's still $50,000 a year because it's not tied to the market. So
Wow.
Annuities are the most efficient and effective tool for creating retirement income because of the higher withdrawal rate, because there's simply no market risk. And the reason I like to implement that as a part of a client's plan is because it actually secures the income floor along with their Social Security, but it allows us to be more aggressive with the investment portfolio that we have on the side, because we're not relying on the investments to create that baseline level of income. So what I have found in my career is combining an annuity for the income portion with the investment portfolio, actually more confidence, more security, more income, but actually more long-term wealth as well, because we can have the remaining investments invested more aggressively.
Interesting. That's a good way to look at it. So when you talk about annuities with creating income, it almost sounds like it's in a way like a pension. So how valuable could that be for someone who doesn't have a traditional pension system? Because haven't those gone the way of the dinosaur? Everybody gets a 401k. Nobody gets a pension anymore.
So it sounds like you're funding your own personal pension. That's exactly what you're doing. And that's so important because the previous generations, they didn't have to rely on their personal savings or 401ks. They had pensions. They had Social Security. They relied very little on their own personal savings. But like you said, pensions have gone extinct. They've gone the way of the dinosaurs, right? Most people, it's less than 15% of private sector workers have pensions anymore. And that's problematic because it's shifted all of the risk and all of the liability from their company onto the individual investor themselves. And unfortunately, they're failing miserably. So what this does, using this strategy, what it does is it removes market risk. It removes longevity risk. It removes sequence of returns risk. It removes withdrawal rate risk. An annuity is the only financial product that can remove all of these key retirement risks and can really secure your income like pensions used to do.
That's a great point, because that's, like you said, that barely anybody gets that thing anymore. They have all of their money, or the vast majority of their money, exposed to market volatility, exposed to market risk. And I think the average person just feels like they don't really have an alternative option.
Absolutely. Again, we're not talking about putting all of the money into an annuity. Based on my practices with my clients, when we're implementing an annuity, it's typically somewhere around 1/3 of the portfolio, right? So if someone tells me like, hey, I want to retire 3 years from now, and we know what the Social Security benefits will be at that time, we know what their investment portfolio is, I think it makes a ton of sense to say, hey, the market is near all-time highs right now. Let's take some of your winnings off the table, lock in your profits, and use those profits to buy a pension. That way, when you retire in 3 years, you can retire on time, exactly when you can retire, and exactly on how much money or how much income, right? Because if the market crashes 40% between now and then, you're unaffected. Exactly what your income is going to be, and you can still retire. Like, yes, it's going to suck watching your investment portfolio go down, but we're not relying on that. We don't need that to get you retired on time, which allows us a time to let your investment portfolio recover and come back. To me, it's just a much better way of doing things. From an emotional, like a behavioral standpoint, it allows people to be much more comfortable knowing that they have an income floor and that their investments are really just icing on the cake to leave legacy wealth, to battle inflation over the long term. But I do not believe that you need inflation protection on your entire retirement income for your whole life, because at some point as you age, your spending is going to fall off a cliff. What we really need is a lot of income up front when you're young enough, you're healthy enough, you have enough energy that you're going to go out and use it. And that's exactly what an annuity can do. It allows you to spend and spend and spend and spend and spend where you won't run out of money, regardless of what the market does or regardless of how long you live.
And that leads into the next question here for you, Ron. I think you mentioned earlier, hey, if you're going to retire in 3 years, you got this annuity. It doesn't matter if the market goes down in this 3-year window. What's like one of the biggest risks that somebody faces when they're getting ready to retirement? Isn't it the sequence of the returns that they experience? Like if they retire into an early bear market or a down market, can you better explain a little bit more on how an annuity can really help mitigate that?
I would say that's a retiree's number one risk, is when they retire into a bear market, or that the market goes down substantially right after they retire, right when they're beginning to withdraw from their portfolio. And I think that conventional wisdom is all wrong. Conventional wisdom says the older you get, the more money you should have in conservative assets like bonds and treasuries and cash. And that's actually incorrect, because who is a market downturn going to affect more? Somebody who's 85 or somebody who's 65? It's going to affect someone who's 65 way more. Number one, an 85-year-old, they don't have enough life expectancy left in front of them where they have to provide income. Right. And number two, they're not going to be anywhere near as active with their discretionary expenses. Someone who's 65, if they retire with $1 million and within a couple of years that $1 million goes down to $500,000 as a result of a market decline combined with their withdrawals, they're going to be screwed because they got another 27 years of retirement that they need to fund.
Right.
So we call that the retirement red zone. The 4 or 5 years before you retire, and the first 4 or 5 years of retirement where you first begin withdrawing from your portfolio. That is the key time where you don't want to make a big mistake, where you don't want to experience any losses. So if somebody were to ask me, Ron, when is a time in my life where I have to be really careful not to make a mistake and not lose money? It's going to be right there in the retirement red zone. Generally speaking, that's going to be basically between the ages of 60 to 70 for most people. And what an annuity can do is it can take with a portion of your money, not all of it, with a portion of your money, it's going to remove it from market risk, remove from the sequence of return risk. It's going to take your winnings off the table, lock in your profits, buy yourself a personal pension, and secure a very high income that you can rely on when you retire.
That's a great answer to that. I think the next thing that people might want to try to improve is how much of my assets can I actually safely spend. We talked about the 4% rule already, a number that is anchored in a lot of people's mind. And we've talked about how the annuity can help reduce exposure to volatility and mitigate sequence of returns risk. When it comes to that 4% safe withdrawal rate, what's the relationship with that with an annuity? Are you still bound by those same rules? How can a guaranteed income annuity affect the percentage of your money that you're safely able to spend?
Absolutely. It raises it, and it raises it pretty significantly. Now, again, the payout rates are going to differ for everybody. It's going to depend on the age when you take the income. It's going to depend on whether you're married and whether you want survivor benefits. It's going to depend on exactly when you rolled it over and how long your deferral period is. But on average, for my clients, we're securing about an 8% payout rate with these annuities. Meaning, if you were to put $100,000 of capital into one of these, it's going to pay you out an $8,000 a year pension, which doesn't sound like very much, but we rarely do annuities that big. Conversely, if someone puts $500,000 into one of these annuities, that's going to give you $40,000 a year as a guaranteed pension. Compared to if you left that $500,000 in stocks and bonds and you're taking out 4% per year using the safe withdrawal rate, that's only $20,000 of income. Right. So in this case, an annuity can literally double the safe withdrawal rate and do it not your safe withdrawal rate, you still got a 5 to 10% chance of failure. An annuity is guaranteed. There's 0% chance of failure because there's no market risk there. Now, when we use these annuities, we don't put all the money into an annuity. We still have an investment portfolio. So what we do a lot of times is we use the annuity to remove the strain on the investment portfolio to produce a retirement income. But sometimes we're still taking out 3 or 4% of the investment portfolio as well. But that's why we sit down with the client. We ask, what are your retirement income goals? When do you want to retire? Do you have a pension? What does your Social Security look like? And how much income do we need to aim for? And sometimes it's simply using an annuity, removing the strain from the investment portfolio, and then taking 4% from the portfolio as well. Quite frankly, I really want to put the least amount of money that I need to into the annuity to make all of these different withdrawal rates and ratios work.
And is there a concern of liquidity with an annuity? I know there's, depending on who you talk to, especially some of the Dave Ramsey people who criticize annuities, they'll say that you're giving up control over your money and it's not worth it. What's the trade-off there? Is it really as bad as people like Dave Ramsey says it is? What are the liquidity downsides with an annuity, or even is there a liquidity downside? Can you talk a little bit more about that?
So the liquidity downside, number one, is completely overstated. You're only going to run into that issue if you put all the money into an annuity, and I'm not doing that, and I doubt anybody is really doing that. At the end of the day, you got to figure out, what is the quality of the advice that I'm listening to? If you're listening to a Wall Street broker or somebody who's sponsored by mutual fund companies, they're going to try to down talk annuities because that is competition for what the brokerage firm is selling. Likewise, if you're talking to an insurance licensed only agent who works for a life insurance company, they may try to get you to put all of your money into an annuity, and that's not the right thing to do either. Like most things in life, the truth is somewhere in the middle, right? So if we're putting, let's say, 1/3 of a client's portfolio into an annuity to secure the retirement income, that means we still got plenty of cash in the bank, and 2/3 of their investment portfolio is still an investment, right? So is that trade-off worth it? Absolutely, because in most cases, I'm doubling the safe withdrawal rate, and it's providing the client with a lot more retirement.
I think that's a good way to look at it, because like you were saying at the beginning, the main objective for retirement it's not necessarily having a big number on a piece of paper on what you actually have in your account. It's how can you actually spend that? What does that actually mean? Like, what good is having $1 million if you can only live off of like 30 or 40 grand a year? Like, that's like, what's the point? The point of all of this isn't the point of all of this to generate a paycheck that we can safely rely on.
100%. That's what I love about using annuities in a retirement income plan, because it does give you permission to spend. Some of my clients that have built up a couple $1 million, where they're like that middle class millionaire, they have $2 million, and they got that way because they disciplined, they saved, they sacrificed, and they have a very hard time once they reach retirement, all of a sudden flipping that switch and starting to spend their money and enjoy it. There's 30 or 40 years of mental programming in their head to not spend that money. And if it's going to be all left invested in stocks and bonds, they start to have this mental paradigm where they live a just in case retirement or a what if retirement. Well, what if I live into my 90s? What if the market crashes? What if I need long-term care? They have all these what ifs, and so they never spend their money, right? And then what happens to the money? They die, the money goes to the kids. And then the kids are the ones, the kids buy the boat, the kids take the trips, the kids travel the world. The kids actually do everything that was on the parents' bucket list that the parents never did because they felt guilty about spending their money. So when you use an annuity to create your own personalized pension, it gives you permission to spend, because that money's going to come no matter how long you live. That money's going to come no matter what the stock market does. And in fact, a lot of the annuities that I use, when somebody goes into long-term care, whatever that pension is, if they have a $40,000 a year pension, that pension doubles and goes up to $80,000 and provides extra income to help them handle long-term care. So some of these annuities even have long-term care benefits on there as well. Annuities are not a replacement for stocks. Annuities are a replacement for bonds. This is just my opinion. This is not investment advice. My opinion, bonds have been a terrible long-term investment over the last 20 years. 35 years ago, you used to be able to put money in bonds and get a 6 to 7% yield, preserve your principal, and just spend that interest. You cannot do that anymore. Somebody actually put the return for Fidelity's bond fund here in the, I'm familiar with the ticker symbol, and it's averaged like 1.51% over the last 10 years. And the traditional retirement moderate portfolio is 60% stocks, 40% bonds. Why in the hell would you put 40% of your money into an instrument that in the current interest rate environment has only done an average total return of 1.51% per year? That's why I'm reaching into the portfolio, removing some of those bonds, using it to create a guaranteed income through this pension strategy, because annuities are just far better than bonds at creating income in this environment. And then I'm taking some of the money that used to sit in bonds and I'm rolling them over into stocks, whether that's some value stocks, some dividend stocks, buffered ETFs, even some structured notes I use, because this is, again, me personally, not investment advice. But in my investment portfolio, I use very little bonds as far as a long-term holding, and I use structured notes instead. Although I'll move into bonds temporarily for short-term market volatility, like we saw in March. I'll reduce some of the exposure to growth stocks and increase some of the exposure to bonds. But again, that's just temporary. For me, and I had a client ask this too, like, my stocks are doing pretty good. Like, I don't know if I want to do an annuity. And I showed him the bonds he had in his portfolio, how terrible they've performed. I said, listen, Jeff, I said, we're not replacing your stocks. I'm going to reach into your portfolio and replace some of these terrible ass bonds that are in there, high fees, low performance. I'm going to create a pension for you guys. So you retire here in a few years, you got $75,000 guaranteed between your annuity and Social Security, and you're projected to have $1 million that'll mostly be in stocks at that. So again, that's just my philosophy. That's the way that I do things. That's not investment advice, but I think it's just a much better way to go about things than traditional retirement planning paradigms. So Mike, really appreciate that. Again, guys, if you're interested, make sure that you follow me and you can book a consultation. You can also use the Calendly link. I think I have like a link in my home screen that they can go to. And Mike, we'll do this again. Thanks, brother. Really appreciate it.
It was great.